Welcome to the new era of video creation with AI stock picking. Let's start it. Here are the contents. Meta Platforms is a cornerstone of the global digital ecosystem, operating three of the most used apps on the planet: Facebook, Instagram, and WhatsApp. With over 3 billion daily active users, it has unrivaled reach in digital advertising, which remains its cash cow. Beyond ads, Meta is pivoting aggressively toward AI infrastructure and virtual augmented reality, areas that could shape the next computing paradigm. Its Meta AI models are now embedded into messaging, Instagram search, and eventually, glasses or wearables. That said, Meta's stock is not for the faint of heart. It tends to be more volatile than Microsoft or Apple, largely due to founder Mark Zuckerberg's long-term moonshots like the metaverse, which have consumed billions with uncertain near-term payoff. However, this willingness to take bold bets also positions Meta as one of the few companies capable of shaping the next tech frontier. For long-term investors, the key is balancing Meta's strong core business with the risks from regulation, public sentiment, and capital-heavy innovation. In this presentation, we'll break down where the stock stands now, what kind of pullback would create a compelling buy zone, and how to think about valuation versus vision when making your decision. Meta stock is currently hovering around $470, a price that reflects both strong fundamentals and extremely high investor expectations. The company's Q1 earnings were solid, with strong ad revenue and continued cost discipline, which the market loved. However, its Q2 guidance came in a bit lighter than Wall Street hoped, signaling slower growth ahead. Despite that, the stock remains near all-time highs, driven largely by optimism about Meta's AI investments and its ongoing share repurchase program. At a forward P/E ratio of about 25, Meta is trading at a premium to its 5-year average. While not as stretched as Apple or Microsoft, it still suggests high growth is priced in. This creates a bit of a risk. Even if Meta executes well, there may not be much room for upside unless the company surprises to the upside in revenue, user growth, or AI monetization. Additionally, the AI narrative has added speculative momentum. Investors may be overestimating how soon Meta can truly monetize AI-enhanced experiences or AR hardware. All this means now may not be the best time to enter unless you're fully comfortable with riding out near-term volatility. On the next slide, we'll explore the ideal buy range based on both valuation and sentiment reset. For a stock like Meta, a more attractive entry zone sits between $390 and $420. In that range, the valuation normalizes closer to a 20-22x forward P/E, a reasonable multiple for a company growing earnings at 10 to 15% annually while investing heavily in next-gen platforms. Historically, Meta has offered strong returns when bought near this level after periods of overexcitement. That $410 area also coincides with technical support levels established earlier this year during consolidation phases. It's a psychological comfort zone for institutional buyers, and a potential floor if we see sector-wide volatility. Importantly, this zone gives you exposure to the AI and social media growth story with a stronger margin of safety. Meta is known for sharp dips followed by strong recoveries, especially when sentiment overshoots reality. Waiting for that sentiment reset, such as from weaker than expected ad spending or metaverse delays, can offer you an entry point that allows long-term compounding without the anxiety of short-term valuation compression. This isn't about finding the perfect price. It's about making a smart, patient decision. While Meta is clearly leaning into the future with AI and immersive tech, there are good reasons to wait before buying at today's highs. First, monetization of AI tools like Meta AI or Ray-Ban smart glasses is still speculative. While it's exciting, it hasn't yet produced significant revenue. So you're paying for potential, not proven growth. Second, Meta remains under consistent scrutiny. Antitrust investigations in the US and EU, privacy regulations like GDPR, and political backlash can affect user data policies, ad targeting, and brand perception. These risks don't always show up in earnings reports until they hit suddenly. And when they do, they tend to move the stock fast. Third, the Reality Labs division continues to burn billions each year. While it may pay off long term, for now it's a drag on earnings. If market sentiment turns cautious, or if AI expectations cool, Meta could easily drop 10 to 15%, as it has multiple times in the past. That kind of pullback would give you the same company, the same upside, but at a much more favorable entry point. Don't chase. Let the price come to you. To conclude, Meta is undeniably one of the most influential and ambitious tech companies today. It dominates global communication, drives digital advertising trends, and is investing aggressively in what could be the next interface of computing. But even bold visions can be overvalued in the short run. That's where discipline comes in. With the stock near $470, most of the good news is already reflected in the price. AI progress, ad strength, and efficiency gains are all priced in. That doesn't mean Meta is a bad investment. It means now isn't necessarily the best moment to buy. By aiming for an entry around $390 to $420, you get the same growth story at a significantly better valuation. You lower your risk while preserving your upside. Great investing isn't just about picking winners. It's about entering at the right time. With Meta, you don't have to chase today's hype. You can watch, wait, and be ready when the market gives you a better deal. Because when it comes to long-term investing, the price you pay matters just as much as the company you believe in.